I'm Mark Riedy. I'm the Executive Director of the Burnham-Moore Center for Real Estate at the University of San Diego. I spent about 20 years in the real estate industry, the mortgage industry, working with housing and mortgage markets. They represent an IOU, meaning if you buy a house and you don't make your mortgage payments on a timely basis, you can lose your house. The lender can take it away from you. So the mortgage is sort of the instrument or piece of paper that really ties you to the house and forces you to make your payments on time. The mortgages over the last 20 years have changed dramatically because people, whether they're college students, high school students, or adults trying to buy a house, have to figure out a way that the mortgage fits their needs. And if you used a standard mortgage for everybody, it wouldn't fit most of the people that want to buy houses. So it's really important, and the lenders have responded properly, that they can create a mortgage that no matter who you are, what your financial situation is, they can probably help you buy a house. The standard mortgage for the last 40 years has been one that lasted for 30 years, and the interest rate on the loan never changed over the entire 30 years. Since then, they have created mortgages where the interest rate could change monthly, or every 6 months, or every year, or every 10 years. Again, it varies because of the needs of the borrower. There are loans that are only for 10 years. There are loans that are only for 15 years. Each one of those, the shorter the time of the mortgage, the faster you have to pay it off, so the higher your monthly payments. So a 10-year loan will have much higher interest rates and mortgage payments monthly than a 30-year loan would have. Again, trying to match the borrower's needs with what the lenders can offer. The sooner you start studying any subject, the better off you will be when you have to address that subject. So a high school student, not only because of where they're living currently, whether it's a rental or a home or anywhere else, needs to be thinking ahead 4, 5, 6 years from then about how they will qualify for a mortgage and be able to buy a house, whether or not they want to buy a house or move into an apartment, because the American landscape for housing is changing rather significantly. And what I mean by that is, historically in this country, about 2/3 of all families lived in houses that they owned, and over the last 5 years that number went up to about 69%, and a lot of people really didn't qualify at that higher number. Too many families didn't and lost their homes over the last 5 years. And today we're probably back to 65% or even a little bit lower. And I think in the future what high school students need to think about is, by the time they're ready to buy a house, maybe only 60% of all families will live in housing. So they have to be looking both at buying a house and the prospect of renting a house, and what they can do now to qualify to either buy or rent later on. The California mortgage market is probably the most creative in America because the housing needs are the most diverse. And what potential borrowers need to understand, even in high school, is that the housing market will have cycles. It'll be up price-wise, it'll be down. The number of sales will be up and down, not always at the same time. Usually when sales are falling off, housing prices have to come down. But in California, housing prices have skyrocketed, and starting about in 2008, they got so high that the majority of families, not only in America but in California in particular, couldn't afford to buy a house. So they backed out of the housing market, and when that happened and demand fell off, housing prices started coming down because the market works that way. The problem with housing prices coming down is that a lot of people borrowed money when housing prices were high, and they had to make those high monthly payments, and they couldn't afford to make them. When they sold their houses, as they're doing now, being in trouble, it depresses prices further. And so someday the high school students of today will be able to afford a house better because prices have come down so far in California. But right now it's been devastating for literally hundreds of thousands of families. The lessons I think we need to take away are, first of all, you need to be sure that you have a job, and a good paying job. The second is that you need to study the mortgage market, so when you get there you can work with a lender to figure out the kind of loan that you want and will work for you. probably most importantly, don't ever be misled to believe that housing prices will always go up, because they will come down. Maybe not this year or even in 3 years from now, but they're going to go up probably over the next 5 or 7 years, but ineluctably they will come down again. So you need to understand that unlike a lot of other things where prices just keep going up, housing prices don't. Now, despite that, on the average, housing prices do keep going up, especially in California. And what that means is that as you are growing up and trying to figure out where to invest your money, a house is probably one of the best investments you can make. You have to be mindful of the risks, but nonetheless, on the average, over your lifetime, buying a house is probably a great investment. Well, the housing and mortgage markets, again, number one, demonstrate cycles up and down, but number two, different parts of the country respond to the economic situation differently, so that you might have housing market opportunities because prices are low in California, where the housing prices in Florida are much, much higher. You may have the Midwest being depressed, but housing prices in California may be skyrocketing, or in Texas. Sometimes, like California, the historical average is that prices move up dramatically. In other parts of the country, like the Midwest, where manufacturing has fallen off, prices aren't going to go up much. So you have to think about where you want to live, whether or not you can afford to live there, and never forget that housing prices are going to have cycles no matter what the real estate agent or your friends or your parents tell you. As long as you're aware of that, and these are lessons that go on over decades, so I'm not just saying what's happening currently. It's something that high school students have to be prepared for, and again, the sooner they just start paying attention to it, reading the paper a little bit, talking to their parents, talking to their friends, the better they will be ready to decide if they want to buy a house or want to rent when they get out of high school or through the college years, and make an informed decision. And one other point in particular that high school students need to understand is that they need to start today worrying about what's called their credit score. Now, most people don't understand what a credit score is, but basically it's a number that people who lend money to you will devise based on your behavior. Are you willing to pay back loans that you have? Are you able to pay back loans you have? And that includes student loans, car loans, loans for anything you want to buy. And if you show that you are consistently able and willing to pay back a mortgage or any other borrowing, then what's called your credit score will go up. If you don't do that properly, your credit score will come down, and you say, well, who cares about that? When you go to buy a car 5 years from now, if you try to go buy a house 5 years from now, the first thing the lender is going to look at is your credit score. And that means if you abuse it today, if you take out too many credit cards, if you don't pay your bills, you're not going to be able to buy a house or a car 5 years from now because the credit score is too low. So every year you need to look at it with the goal of raising it 10 or 20 or 30 or 40 points. A good number is somewhere probably above 700. An excellent number is 800 or close to 800. But anything in the 620 or 630 range, you're right on the verge of having a difficult time borrowing money. So the first thing I'd say is, even for a high school student, they need to check their credit score now and start behaving credit-wise so that their credit report or the credit score will improve every year. Credit score does a couple of things. One, it determines whether or not you can borrow at all. And so if it's too low, you can't borrow at all. It doesn't matter. The other is that if it's marginal, the lender may make you a loan, but they're going to charge you higher rates of interest or make you pay more points. And points simply means extra interest you're paying, but you pay it the day you get the mortgage. So because of that problem, because credit scores have gotten fairly low with high unemployment in this country and a lot of bankruptcies and foreclosures, lenders have had to figure out new creative ways to make mortgages available that are mindful of these low credit scores. And the risk there from even a borrower's point of view is, do I want to get into a house that I can barely afford? Because if I have any problems with jobs in the future, or my husband or wife has trouble with a job, we may not be able to make the mortgage payments, and the lender by right can take the house away. So it's really important to judge your credit score, find a mortgage that works, and buy a house that you truly can afford with a little in reserve in case of a rainy day.